Explain to me the different types of structured notes and how you use those for your clients.
We personally use them with two main types of structured notes. And there's some other ones that are a little different than this, but the two main types we have are we call them income notes, which they work very similar to how a bond works. And then we have what are called growth notes, which work more like a growth stock vehicle, like an exchange traded fund, the S&P 500, or anything that's growth oriented that owns stocks. The income notes, they usually go between 1 and 5 years out. They have a maturity date. They have a defined amount you're going to make, just like a bond might give you 5 or 6% a year. These notes that we happen to use often pay high single digits to low double digits. Circumstances that are going on in the world and the markets and interest rates and all of that affect what the return is. Banks put them together, so we buy them through banks, and you name the big bank and they do it. Citibank, Morgan Stanley, JP Morgan, all the big banks across the world. And they will take, let's say, two or three indexes, the S&P 500, the Dow Jones, and the NASDAQ. And they will use the volatility, like you were talking about. They are using these option contracts. They use the volatility and they will couple them together. They will say you can only make 10% in a year. Not only, it's still a lot, but you give away making 15 or 20 in a good year. And so in those years, that extra return, they use some of that as insurance to protect the downside. So a typical one might be tied to those three indexes. It's 5 years out, it pays 10% a year, and it will protect you on the downside as long as none of those three indexes in 5 years when they mature, if they don't go down more than 40%, if they go down 10 or 15 or 20 or 30 or whatever, you get your money back. It's not a CD, but it has the same element of protection where your principal is protected as long as it doesn't go down more than that threshold of 40%. So when you look at it at face value and you step back and say, I'm only going to lose money if it's down more than 40%, the percentage likelihood of a stock index being that far down in 5 years is very, very, very low. There's only a few instances in the history of the stock market where that's happened.
Because that's a 5-year cumulative number, right? So it's a 5-year note, negative 35%. I mean, yes, we've had negative 35% years. Not even very many of those. I mean, it's happened to, I don't know, half a dozen times, a dozen times we've gone down that much in a 12-month
Not
period.
even. Yeah.
But 5 years, we're talking, Great Depression's the only one that we've had.
It's called it's the rolling, it's the point to point 5 years. You're 100% right. And we tell clients that, and we've seen it. We've been doing these notes for around 8 or 9 years now. And we've seen it in 2 or 3 instances where the stock market, COVID, stock market gets absolutely annihilated. It was a very short period of time and then bounces back. And that's what we've seen. Even if we go back to the tech bubble, which was almost 25 years ago now, we go back to 2008, the credit crisis. Even during those times when the markets were down they bounce soon thereafter because a lot of things are happening in the economy and businesses and the government's lowering interest rates, and all of a sudden good things happen and the market bounces. And so that's why these are fairly stable for the most part when you own them a little bit longer. So that's the first kind. That's the first type of structured note.
The statistical probability of it being down 35% is not your key risk consideration. You're thinking about the credit worthiness of the issue, or that's the ultimate thing, because there comes a point in time where in order for this scenario to happen, everything else around you is so bad that really is the least of your problem. Like, if the world ends, how will this portfolio do? And I'm like, terrible. There's not an answer to that, right? There becomes a scenario where if you're protecting against that, I got nothing for you.
Right. We run the math and use the logic, but to your point, we tell our clients as well, we cannot solve for Armageddon. and Armageddon is something that has, at the end of the day, there's an infinite number of risks that can happen. And so we want to put our best position to avoid what we do know and what we do see mathematically.
So then, James, tell me a little bit about growth notes. I know that's another form of structured notes that you all use there. So talk to me a little bit about those.
You bet. So unlike income, which again, income pays you a stream of income over each and every year and then your money back at the end, a growth note is very similar on the downside protection piece, where you have a contingent protection, 30 or 40% protection, and you get all your money back in case those indexes are down. The difference is on the upside. So what clients are giving up in growth is any return, money back, dividends, interest each and every year. They get a pop at the end. And so we'll use an example of a 5-year growth note tied to the United States stock market. I'll blanket it there. You take the United States stock market return. Again, you're not getting any payments for the whole period of 5 years. So you have to stay patient. We have to teach our clients, stay patient on this. However, at the end, you receive a leverage factor, a multiplier of that return of the United States stock market. So we might use the S&P and the Russell and the Dow. And what happens is they're correlated. So you take the worst performer of those three, which in reality, one might be up a total over that 5 years of 40%, one might be up 32, and one might be up 28. So you take the worst of those three, if that's the case, and you take that 28%, and it's often 1.5 times that, for example. So 28% times 1.5, what is that? 42% return. That is your return over that 5-year period of time by staying patient. Giving those examples, this is where people bet on the future for growth. When you combine income for stability and returns with growth of, hey, if the market does really well for 5 years, I can double my money. When typically I double my money every 10 years, the 7% rate of return. And so our job as advisors is to mix and match what makes sense given a client's situation. And the last I'll share on both of these notes is, you want to spread out the years for, time risk. You want to spread out the banks for concentration risk with banks. You want to make sure it's in an asset location, tax efficient strategy, And so all these tie together within the holistic approach, but that's all alternative investments for those clients that it makes sense for.
Just like what James was mentioning, when COVID happened, we bought one that was literally just tied to the S&P 500 because the conditions are when things are more volatile, these are more attractive. It was 1.65 times the S&P 500, and it was just tied to the S&P 500. So the S&P 500 since COVID has skyrocketed.
Right.
This thing has exploded, and so it's gone up in proportion. So that happens inside of these as well, whether they're income or growth or whatever. Now, actually, we can find some of these that are actually paying, we've been buying these for clients that are close to 2 times the S&P 500 and the downside protection. So as James said, we make sure we take both types of notes and we put them in a portfolio based upon a client's overall circumstances. And one thing is key, like if you have a defined benefit plan, like you said, Garrett, we've got to go, okay, how do we put these in, and how do we actually will use more of the income notes in the defined benefit plan portfolios because they create some stability, like you said, but they do fluctuate in value based upon if you sold it early. But if we tell clients, sometimes it drops, like it's tied to the market, those income notes, they drop. If the investments are down 20%, they'll be down 20%. But we call up the client, we're like, Mr. and Mrs. Client, remember, you got the 35 or 40% downside protection. As long as it bounces back, or even doesn't bounce back, you're going to get your principal back when it matures. And sure enough, we see them, then they come right back, and then they get their money back.
So they act really from a trading standpoint. It sounds more like a bond. It's issued, and then there's a maturity date, but they trade ongoing. So even though you're saying a 5-year note, that may have been a 5-year note, but you could buy a 5-year note that's got 6 months left to expiration or maturity. So there is also a timing element of that as well. As you're looking at, as you're structuring these things out, you mentioned diversifying by issuer, by index, but also time horizon. You could go shorter term, I suppose, if you wanted to on those, if you saw the right opportunities.
You can buy them on the secondary market. We typically don't like to, but there's 1-year notes you can buy in the primary market, 2-year, 3-year, et cetera. So,
and how liquid are these to trade? I mean, I don't even know if I were still managing money and someone said they wanted to buy a structured note, I wouldn't even know where to go and buy one. Like, where do you go to buy these things? And is that something you go through as an RIA? I mean, are you going through your custodian, or are you going directly to the vendors or the issuers?
Both. The major custodians have the banks every month will put what are called on the shelf options, and you can just pick from them and buy them through the custodian. We do a lot of them. And so because of that, we actually know various desks that specialize in helping them put together. We actually do our own what are called auctions, where we go out to the banks and actually say, hey, we got a chunk of money. we're going to have you compete. We want the structure to be this way. And then they all say, okay, I'll give you 9, I'll give you 9.5, I'll give you 10. Then we take the one that pays the most. So there's a variety of ways of doing it. But for the most part, a layman would have a hard time getting very many good choices on their own. This specialty really does create a massive
Alpha.
advantage. Yeah, I mean, we probably get, because of our expertise, an extra 1 or 2% a year, just because of how we're able to access them, than somebody could on their own.
I was just going to mention on the liquidity piece, they don't trade like a stock where you just click a button, but it's liquid. I mean, the key will be the pricing and make sure it's similar to, say, a CD. If you wanted to cash in the CD early, there's no penalty for a note, unlike a CD that sometimes have, but you submit a bid, they give you a price, and then you say yes or no. So we tell our clients, expect to hold it for this period of time because that's the goal and that's how it works. But no, in a pinch, an emergency, you need to get out. It's doable.
We have to go to the bank
a day or two notice
and have them and tell them, please price it and then sell it. It takes a day or two extra normally, but it's usually pretty liquid. The banks do reserve the right in a catastrophe and some crazy condition. They can slow it down. So we do tell people ahead of time these could become a little more illiquid in certain circumstances, but for the most part, when we need to get out of them, and once in a while, we have hundreds of these things now for clients, and so once in a while somebody needs some money, then we'll get out of it early. It's usually takes an extra day or two than a mutual fund, let's say.
I like to have a place to kind of explain at the end why someone should get in touch with you. And if you're just telling us because you're the best stock pickers ever, then that's not a very unique story. No. But when it comes to this, I mean, with structured notes, it's really interesting. Even if you let's just say that I love this conversation so much and I've decided I'm going to go and become my own. I'm going to go start investing in structured notes, but I'm not going to hire an advisor. Well, first of all, I'm assuming that there are, with all the different issuers, all the different indexes that are out there and all the different nuances, this is probably not like walking down to my local diner and looking at a menu and picking what I'm in the mood for. There's probably a lot of things to choose from. Am I fair in that?
Hundreds a month. Yeah.
Right. Okay. Hundreds of months and all of these different months, all these different, it's just an onslaught of information to digest. But then even if I am just a supercomputer of a brain that can digest it all and know exactly which ones are the best ones, there's also going to be a leverage that you have as an RIA and an institution that you're able to go and have that negotiating power that Ed was talking about there that I don't have as my own individual. And you said, Ed, that can make a 1 or 2% per year difference. And is that because of your expertise and your knowledge, or that's just because of the volume and the relationships that you have with those to negotiate and make those, not just for the negotiating power, but also knowing how to have those conversations and when to have them and just how to go about that? There's an art to that, I'd imagine.
It's everything. Yeah. Well, first of all, you just have to have probably tens of millions of dollars on your own. And the reason is because then you can go to banks because you need at least a quarter to a half to $1 million to then start shopping. And you can buy these off the shelf. But if you buy, let's say, one that James had suggested or that I had said, S&P 500, Dow Jones, and NASDAQ, you could find probably 10 of those that banks are offering at the end of this month. And they're going to probably pay in the range of, I'm just making an example of 8 to 9 to 9.5%. The various banks will pay. We go to the street and we go to the banks and we say, all right, we're doing an auction. We have $1 million between all of our clients' money. We can probably get 10.5 to 11. And the reason is just because we're going direct, we have more efficiency. And so it's just, this market is way more inefficient. It's kind of like the markets 30 years ago with stocks and bonds and all of that. You don't have the ability to do it because of size. And then, like you said, we're experts. We know how you can construct and the way all of these work and what is more attractive.
Well, hey, thank you guys both for doing this. This was really cool and sincerely educational. I mean, I really enjoy learning more stuff about the markets that I didn't know. And I don't mean to sound arrogant, but I mean, as a CFP, I know a decent amount about a lot of stuff. It's pretty cool to learn something new. And this has been really enlightening, really cool stuff. So thank you both for doing this. And I hope this is the first of a few of these we can do. I'd love to pick your brains on more things down the road.
Great, Garrett. Thanks. We really appreciate
Absolutely.
it.
No.
Let me plug really quick here.
Yeah.
So Ed's Edge podcast, I know it's available on Apple Podcasts. I'm assuming it's on all major podcast provider or podcast platforms.
Yep.
Check them out at edgefa.com. Ed Meek, James Alexander. I will put all the contact information and ways to reach you all, wherever you're at watching this. If you're watching it on YouTube or you're watching it if you're listening to the podcast, somewhere there'll be a description with a link that you can get to those links. But that's how you can find them, and certainly encourage you to do so because they clearly know their stuff. So thanks, guys. Appreciate it.
Thank you.